So hi guys, this is Binay Adhikari. Today we are going to discuss accounting of financial management. Basically, how financial managers can use uh, uh, financial statements, accounting information to make and understand financial decisions. So the context over here is that accounting information is very useful for financial managers to make various financial decisions. However, accounting is different from finance in the sense that accounting is done more on an accrual basis, and finance has more to do with cash flows, the timing and amount of cash flows. So in finance, we tend to focus more uh, in cash inflows and outflows, of when and how much of that occurs. Uh, uh, in that context, we tend to modify financial statement to make them more useful to finance people. Okay, so in this our topic in this chapter is just a basic understanding review of income statement, balance sheet, statement of cash flows, and then we're going to calculate something called free cash flow, calculate and understand the meaning of free cash flow and different performance measures related to a free cash flow and value addition. Now, all of these are going to information to do. All of these are going to come from the firm's finance reporting. So here in this big picture that we have been seeing from day one, the place of free cash flow in this big picture is substantial. So in fact, value of any firm is going to be present value of all the future free cash flows, a cash flow kind of available to investors, discounted as the weighted average cost of capital. So understanding the concept of free cash flow and how to kind of estimate is very, very important. So okay, so we're going to go over some basics of different types of financial statement. The annual report that every publicly traded company must report to the SEC and is available to shareholders. In fact, everyone that wants to access to it consists of mainly four kinds of financial statements. The first, the balance sheet. As you should know, balance sheet just is a snapshot. It's a snapshot of a firm's financial position, its assets, liabilities, and equity at a given point in time. So it's a static statement. It's a snapshot. It's like a picture at a given point in time of the firm's financial position. Whereas the other important financial statement is the income statement, which is the summary of a firm's income and expenses, and any profit or losses over a given period of time. So income statement has a time or a duration element to it. So income statement could be of a quarter or a year, maybe 5 years or a month. However, balance sheet, on the other hand, is the situation of the company at a given point in time, right? So the third type of very important financial statement, especially for finance people, is statement of cash flows. Whereas income statement, income in accounting is driven from accrual concepts. So income does not necessarily mean cash per se, because it also includes many non-cash items, and you don't have to exchange cash to record something as an expense or an income. So cash flow statement is very useful in the sense that it reports the impact of firm's different activities on cash inflows and outflows. So it gives a much clearer and much more objective picture in where the money is coming from and how the money is going out. The statement, so it's very important statement. The first one is the statement of owner's equity, which is basically how shareholders' equity changed over time because of profits or losses. Part of that was part of the profit or losses that were retained or paid out as dividends, and how it impacted the book value of the owner's equity. Okay, so we're going to learn about financial statement with a context of a firm's expansion. So the example in this on these slides are kind of like a case study where a firm decided to undergo a major expansion, and we're going to see how that expansion kind of affected its financial position in different ways. So first, we are going to see how how it affected accounting statements, and then we're going to modify and try to learn what went wrong or what went right, right? So this is the income statement. So what we see is after the expansion of 2017, in 2018, sales increased by a lot, $2.4 million. Uh, but cost of goods sold also increased much more significantly, right? So, and other expenses also went up, and as a result, the company's EBIT, earnings before interest and taxes, or operating income, went significantly down, right? Then after interest expenses and all, the net income for 2018 after the expansion was net income was negative, right? So from the income statement, it doesn't look like the expansion was very good. What does the balance sheet say? The balance sheet, if you compare the balance sheet of these two companies, the asset side of the balance sheet, what we see is that the cash went down from 9,000 to 7,282. Short-term investments also went down. Accounts receivable, the money that we account receivables and inventory both went up. Account receivable is the money that we have not collected from sales. So this is uncollected money, or kind of money to be collected, went up, and inventories went up way much. Okay, so this company looks like it is having difficult time managing its current assets. So similarly, gross fixed assets, the property, plant, and equipment also went significantly up, and that was expected because of the expansion that it acquired another company. So it was kind of expected over there. Net fixed asset after depreciation also went up. So the balance sheet kind of blew up. Balance sheet became much bigger, mainly because of different types of assets and expansion. So if you look at the balance sheet, the liability side, so there was an expansion, but where did the money come from, and how did the operations kind of fared out? So what we see over here is, okay, so from 2000 compared to 2017, 2018, accounts payable also went significantly up. So this is kind of part of the money that our suppliers are financing. Accounts payable is the money that the company owes to the supplier. Notes payable also went up. Note payable actually went up much more, meaning that the company had to borrow money on a short-term basis much more. And accruals, the money the company owns to other parties, for example, salaries payable and wages payable, also went up. So it looks like it is taking on a lot of current liabilities to finance operations. It is also long-term debt of this company also went up a lot. So it looks like the financing of the expansion. So the expansion was done with borrowed money because there was the common stock, the book value of common stock is the same thing. So that they didn't issue any shares for the expansion. It looks like the expansion was done by borrowing money. The retained earnings went down because how does the retained earning changes? It changes from profits and dividends. So this company made a loss in 2018, so the retained earnings went down. So the total equity, book value of equity went down. So see, even if the book value of equity went down, the balance sheet liabilities and equity part is blowing up, mainly because it's taking on a lot of debt. Okay, so now we're going to go to statement of cash flow to understand how the company's cash flow status fared out. Okay, so we know the cash went down, the cash balance decreased between these 2 years. So where did the cash go, right? So we're going to look at a statement of cash flow that will show us how the company made or gained or lost cash, so to speak, from different types of activities. The first one is operating activities, so cash from operations. So in 2018, the company made $90,000 of losses, accounting losses. But these accounting losses have to be adjusted for non-cash items. For example, depreciation has to be added back. And also, we have to account for the fact that a lot of sales that was recorded that became a part that resulted in this net income. Sales and purchases were not made on the cash basis. Some of these were accrual basis. So out of the net income, the company ended up increasing the account receivable $280,000. So that was kind of a drain of cash. It also increased inventories by $572,000. So that was another cash stuck, extra cash stuck in operations. It also increased accounts payable. That kind of helped the cash position because it didn't pay, it hasn't paid for some of the stuff it has bought, and it has also not paid some of the and it resulting in the accruals. After all, considering all that, the operations cash flow from operation is $503,000 negative. That means from the operations part itself drained a lot of cash. So a lot of cash, this company kind of lost a lot of cash, even compared to the net income from operations, mainly because it has invested heavily in account receivables and inventories. Okay. The second part of cash flow statement is investing activities. So the major cash drain happened from investing activities because it acquired a lot of fixed assets. It went into an acquisition, and so in order to finance that, it has to pay a lot of cash. There's a positive cash item in the short-term investment because this company kind of cashed out some of the short-term investment, sold out some cash short-term investment. So from financing activities, this company lost $683,000 of cash. Okay, the third major activities in the cash flow statement is a financing activity, that is raising money from capital holders and paying them back. So from financing activities, looks like the notes payable, the company collected a lot of cash from notes payable. That means basically this company borrowed $520,000 during this year, both in short-term basis and long-term basis. Sorry about that. So it borrowed long-term debt. Change in long-term debt positive means it borrowed a lot of money in the long-term debt. This is how they financed the expansion. And they also paid dividends to the shareholders. So from financing activities, they collected a lot of cash from financing activities, meaning they borrowed a lot of money, mainly to finance the operations. So on net, so from their operations, this is actually the most important part of cash flow statement in some ways. Just shows you from buying and selling stuff, by doing your day-to-day activities, how much cash you gained or lost. And this company lost a lot of cash from financing activities, from operating activities. Made a lot of investments, so investment activities bought a lot of fixed assets, so cash kind of drained out from there. And how did they finance all of that? They financed most of that by borrowing money, which came from the financing activities. Okay, so even if they borrowed a lot of money, the cash outflow was much more than inflows. So the change in cash was $1,718. So if you add these two, so if you subtract $1,718 of change in cash from the beginning of cash, you'll get to the end of cash statement. Okay, so this kind of summarizes the cash flow statement. So it doesn't paint a very good picture of the expansion. The book would be that these are just the initial years of expansion, so you expect them to lose money initially, but as of today, it doesn't look very good. Okay, so now we're trying to kind of go into understanding the financial implications of the expansion of this company's decisions by looking at a concept called free cash flow. Right? So free cash flow is a concept in financial economics. It's not an accounting concept. So free cash flow is, you can think of free cash flow is the money that is in a given year, given period of time, how much money the company made that is available to distribute back to the investors. So this is kind of the amount of cash available from operations that is available to distribute to investors. And free cash flow includes both kinds of investors, debt holders, and equity holders. Okay, so when you calculate free cash flow, we don't subtract interest, because free cash flow is the amount that we say is available to all investors. Okay, and the company's value depends on the amount of free cash flow it can generate. So free cash flow, what's the value of a company? Very simply speaking, it's the present value of all its future cash flows, future free cash flows. Okay, so when we so how do we estimate free cash flow? What does that mean? So we're going to kind of look at an example hopefully later on, hopefully using a spreadsheet. But this is kind of the process of, so before that, so okay, so the company has free cash flow, let's say positive free cash flow. It can have some negative free cash flow. So what does positive free cash flow mean? So what can the company do with it? All right, so free cash flow is free cash flow regardless of whether, so free cash flow is the money you can say available to investors out of the operating profit after satisfying all the minimum investments required to run the business smoothly. Okay, after making all the required investments to run the business smoothly, how much money is available to give back to the investors? It doesn't have to give it back to the investor, it doesn't have to necessarily pay dividends, but it can if it wants to. So free cash flow, you can use free cash flow to pay interest on debt, pay back principal of debt, pay dividends or buy back stock, or make other expansion or investments. But it doesn't have to do this for it to call a free cash flow. All right. So these are the steps involving calculating free cash flow. Okay. So the gist of it, you'll see when we do the example, the gist of it is that free cash flow is just your net operating profits after tax. Okay. So profit from operations. All right. Not including interest. So net operating profit, but after taxes. So that's the kind of money that is available in some ways to investors, but not all of it, because to run the business smoothly, you have to make minimum investments. So from that, you subtract net investment in operating capital. Okay, so these are the process of getting into the net operating capital. So if you subtract all the investment required to run the business smoothly from the net profit after tax, you get to free cash flow, and this is the money you can say is available to investors. Okay, so how does that work? All right, so first item to calculate free cash flow, the first step is to estimate something called the net operating profit after tax. So net operating profit tax is just EBIT, earnings before interest and taxes, or operating profit times 1 minus tax rate. Remember, notice we didn't do EBIT minus interest, right? So what we are trying to calculate here is if this company had no debt, no borrowing, how much money would have been available after tax. Okay, so just from operations, so we're kind of trying to assess operations. So not net operating profit after tax is EBIT times 1 minus tax rate. That's the first step. So not operating profit tax is the amount of operating profit this company made, and now the next step is to subtract the minimum investment required in working capital and long-term investment to keep the business running. So that's the next step. So there are two kinds of investment the company has to make. So one kind of investment will be to investment in current assets or the working capital, such as it has to maintain certain level of cash and inventory and receivables to be able to buy and sell stuff. But the operating current assets, so those are called operating current assets. Operating current assets do not include short-term investment, at least in this book. So even if short-term investment and marketable securities are current assets, those are not operating current assets. Okay. So these are the money this company needs to invest to run the business. But on the other side, some of the operating current assets can be financed by current liabilities, right? So the company can finance its inventory, for example, by increasing accounts payable and accruals, so delaying payment to for example, wages and so on. So these are called operating current liabilities. So, but it will exclude notes payable and so on, because these are kind of financing type of current liabilities, not operating type of current liabilities. Okay. So the net working capital, net operating working capital is just net operating current assets minus the financing side of it, operating current liabilities. So the net of these two is called the net operating working capital. So this is the net working capital this company needs to invest in this year, needs to keep in 2018 for it to run this business smoothly. Okay, so this is just the current type. So the amount of net operating working capital in 2017 was 7,900 about 800,000, and in 18 this investment requirement became bigger to 1,300 more than a million. So from 800,000 to more than a million. So the difference between these two is the extra investment in net operating capital this company had to carry out for a smoother operation of this business. Okay, so that was kind of a drain from free cash flow. So free cash flow decreased or will decrease, as you'll see, because it had to make extra investment in operating working capital. All right, now, but that's not the only kind of investment a company needs to make. So the company also, in order to increase sales, for example, it also needs to, apart from investing in working capital, it also needs to invest in fixed capital or fixed assets. So the operating capital, it's not only operating working capital. Operating capital includes both net operating working capital, but also involves net fixed assets, right? So the operating capital in 2018 this is net operating working capital plus this is the amount of fixed assets in the balance sheet. If you go back to the balance sheet, you'll see that this was the net fixed assets in the 2018. Calculated similarly, in 2017, net operating capital, both working capital and fixed assets, was $1.1 million. It became almost not more than double, but almost double in 2018. So this company was required to make, so the difference between these two is the extra investment, the additional investment it has to make in 2018 to keep the operations running. So that will be kind of a drain in free cash flow because of this additional investment needed. Okay, so the free cash flow is, as we say, this is not operating or working capital, not net operating profit after tax minus the necessary investment in operating capital of both types. Necessary investment in working capital, necessary investment in fixed assets. Okay. All right. So the free cash flow of that year. All right. So so see this bracket. The bracket shows the difference in the working capital. So that will be the net investment in working capital. Okay, not only net investment in operating capital. Both the sum of both operating working capital and net fixed asset. Okay. All right. So the free cash flow of 2018 was massively negative. It says 2017, but this should be for 2018. Okay. Is massively negative. So that means investors actually didn't get anything. In fact, investors' money was drained out of this business in that year. Okay, so how do you suppose investors reacted? All right, investor would react massively negatively if they think this trend is going to continue in the future. On the other hand, if the investors think that this is just a one-time thing because this company is newly expanded, so these are expected things, they might not react that negatively. Okay, so this kind of summarizes how this free cash flow kind of was used and how it come out to be, but we are not going to focus on that too much. Okay, so from once we calculate free cash flow, or even before that, we can compare a different performance measures related to the company. The first performance measure related to the operations of the company. The first performance measure is something called net operating profit after tax. Remember, this is the first thing we calculated to calculate free cash flow. So divided by sales. So this is called operating profitability. That just means, okay, so how much of operating profit you generated out of sales. right? Now it has to do with controlling operating cost. So in 2017, it was 2.15%, whereas in 2018, this ratio, even if sales increase in that year, but operating profit after tax also did not increase as much, or in fact decrease, only became 0.18. So this firm became, in fact, the problem seems to be in the operation itself, because it failed to kind of control its costs well, right? The second one is, okay, how much of capital did you need to generate a dollar of sales, right? So the capital requirement ratio. Okay, so in 2018, the total operating capital, both working capital and a fixed asset, were 2.2 million divided by the sales of 5.8 million, so 38.7%. So you needed like a 39 cents of operating capital to generate a dollar of sales, right? Whereas in 2017, it was 19.5%. So I would check this number because I'm not sure whether this is right. When I do the calculations, this is I get a different number. But anyways, the message over here is the capital requirement ratio increased. That means for the same dollar amount of sales, they needed more operating capital. So why is that bad? Because this operating capital, you have to remember, is financed by the investors. So if the investors put in more money for the same amount of sales, they would want more return from the business, right? So capital utilization worsened in that company. The third in a ratio, a related ratio, is now net operating profit after tax divided by operating capital. Compared to the investment in the operating capital, what was the profit from the operations, right? Not so. So in 2018, the company only made 0.5% of profit over the total operating capital. So they used too much capital to generate too little profit from operations. Okay, so again, this operating capital, smaller the number, the better if you can maintain steady sales, because a bigger number means bigger investment, and bigger investment also means more money that investors will want. Okay, so so another way to look at so the final in financial management, we were concerned about whether or not an activity added value to the shareholders' wealth. Remember, the objective of financial management, as we have been discussing, is to maximize shareholders' wealth. So how can we assess whether this company generated money, added value to the shareholders' wealth? There are two matrices. One, we can look at free cash flow itself. Free cash flow is negative. That means it didn't generate any value for anybody. But the other way to look at it is to see how much profit this company made on operations, net operating profit after tax, and compare that with how much profit, how much return the investors would want at the minimum. So that's why we look at a concept called economic value added, that says, okay, that just subtracts net operating profit after tax from the dollar amount of return from the capital. So net economic value added is net operating profit after tax minus weighted average cost of capital. You remember, this is the required rate of return at this is the minimum rate of return the project must make to satisfy the providers of capital. So weighted average cost of capital is a percentage number times the capital provided by the investors. So these will give you the dollar amount of profit the providers of capital must earn on their investment, and this is the dollar amount of profit this company made. All right. So in 2018, so we are going to assume that the weighted average cost of capital is 10% in both years. So if you do that, this is operating total capital. In 2018, net operating profit after tax was, so this company made $10,464, whereas the minimum required rate of return and the minimum dollar amount the investors would want was $225,000. So they fell massively short. So the economic value added of this company was negative. This company generated much less than what the investors would want. So you'd expect the stock prices actually fell after this. So compared similarly, economic value added in 2017 was $11,600. So in 2017, this company made more than the investors required minimum required rate of return dollars. In 2018, it fell short massively. Okay, now so this is economic value added. There is another concept called market value added, meaning if you look at the stock prices of the company and calculate the market value of the shares, how does that look compared to the book value of the shares or the book value of the stockholders' equity? Okay, so we are given information that in 2018 the stock price per share became $6. 2017 it was $8.50. There were 100,000 shares outstanding. Remember, this company did not increase the number of shares. So we can use this number of shares times stock price to calculate total market value of equity. All right, and then you can compare that to the book value of equity. All right, so in 2018 the market value of equity was $600,000. So 6 times 100,000 minus in the book value of the equity in the balance sheet was $557,000. So market value added. So market still placed like a positive value over their investment, the book value of equity in 2018, but this value added, this market value added decreased compared to 2017, right? So this looks like market is also kind of discounting. Market is not very optimistic about what the company is going to do in the future, or the company will fare in the future. So the expansion kind of doesn't look very good to the company so far. All right, so so next we're going to do a spreadsheet kind of going over some of these calculations. All right, thank you.